The VIX volatility index falling below 15 for the first time since February. For more, let's bring in Mandy Xu, head of derivatives market intelligence for CBOE Global Markets. Mandy, it's always great to see you.
Great to be here.
It's not just the VIX. I mean, volatility across asset classes, bond volatility is also very low. What does this tell you?
Yeah, to me, I think it's a sign that what we're seeing in the markets is very much fundamentally driven, right? The fact that equities keep making new all-time highs and volatility is falling across all asset classes is a sign that economic data continues to come in better than expected, and earnings are holding up much better than expected as well. So I think, to me, that's reassuring because there's a lot of headlines around kind of complacency and frothiness in the market. Certainly, I think there are corners in the market that are very frothy, but ultimately, I think this rally and the fact that the low volatility that we're seeing is really across the board, across asset classes, tell me it's really based on strong macro fundamentals.
It's interesting that you can come and say that, you know, it's confirmation of the good news story about the economy when so many people are saying, no, it's complacency and we're in for a giant pullback.
So I would say if only equity volatility was low, only the VIX is low, and bond market and other asset class volatilities are high, certainly I would say there's something going on. The other thing I would caution, though, is just a lot of times people look at the level of the VIX and say, well, if it's low, it must be complacency. And the way that we actually evaluate it is against levels of realized volatility in the market. And VIX at 14 may be low, but the realized volatility in the market right now, we're talking about 6. Right, 6%. That's at a one-year low. So actually the spread, the difference, what we call the volatility risk premium, or how much additional risk premium that option traders are pricing in for the forward outlook, that's actually toward a one-year high. So that's telling you that really why volatility is so low is because market continues to grind higher, and then actually in the forward outlook, option traders are actually pricing in some risk premium.
So what would happen if the Fed were to cut? What do you think would happen to the VIX and therefore the markets, or the other way around? Ask the question, I guess.
Yeah, certainly. I think any question about the Fed rate cut really comes down to why are they cutting, right? So a lot of times people think reflexively rate cuts are good for equities. And if you look at it historically, that's not always the case. If the Fed is cutting because data is coming in, economic data is coming much worse than expected, then you often get situations where Fed is cutting and stocks are selling off. But all that said, I think right now, if the Fed were to cut, it will probably be because of the inflation outlook and inflation coming in much tamer than expected, in which case I actually think that could be another positive catalyst for the rally.
Now, we also have a tariff deadline, which is coming up, right? And I think this has happened in the past. It just keeps getting pushed. So at this point, volatility is low because everybody's saying, well, it's either going to there's going to be deals made or it's going to get pushed again, I think is what the volatility index is telling us, if I'm correct.
Yeah, so it's interesting, actually. So I would say coming into the July 9th, the previous two deadlines, the April 2nd Liberation Day and the July 9th deadlines, there was really nothing being priced in the options market in terms of risk premium for that particular event, really kind of telling you that people really didn't take it seriously. This time around, heading into the August 1st deadline next week, we're actually seeing a little bit of a kink in the volatility term structure, which is another way of saying an excess bump in volatility for options that are expiring August 1st. Now, you could say that's really a sign of anxiety around tariffs, but I actually think it's because it's also happening the same day as non-farm payrolls, and it's really the macroeconomic outlook that is driving that premium. But certainly, I think the market is telling you, expect a little bit additional volatility next Friday.
So just with the strategist hat on, you would expect this market rally to continue?
So I would say, for the past couple of weeks, we've been saying the pink trade is actually to the upside. But I do think there's been enough capitulation at this point and enough people kind of throwing the towel on hedges. We've definitely seen that in the options market that I would say at this point, the pink trade is probably to the downside. But it all depends, obviously, on what happens with trade, what happens with the data, what happens at the Fed meeting. So lots going on.